Hello, everybody, and welcome to another Capital Gains Tax Solutions and Expert CRE Secrets podcast, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the deferred sales trust is an amazing way for you to exit highly appreciated real estate, businesses, cryptocurrency, defer millions of dollars of capital gains tax, eliminate the estate tax, eliminate that need for that really frustrating 1031 exchange so you can create and preserve more wealth, or help your clients, friends, and family do the same. Hey, my name is Brett Swarts. I'm the host of Capital Gains Tax Solutions podcast and the founder of Capital Gains Tax Solutions. And today I'm bringing on an amazing guest. And each and every day we're bringing on some of the best businesses, real estate, and entrepreneurs in the world to share their ideas and deal stories. And today is no exception. In fact, this gentleman's out of the great state of New York. He's a multifaceted real estate executive with a wide-ranging experience in all aspects of acquisition, capital raising, asset management, and investor relations. He's well-versed in value creation for owners and investors. He excels in developing strong working relations with family offices, partners, stakeholders, investors, bankers, brokers, and owners. He has 25 plus years of hand-on relationship building, due diligence, operations, multifamily, industrial, mixed use, student housing, affordable housing, Section 8, and such, and so on. Please welcome to the show with me, Irwin, Boris. Irwin, how are we doing?
Thank you. Good morning, everybody. Thank you for having me.
Absolutely.
Wow, that was a mouthful. I didn't realize I wrote that much. So
That's all right. It's all right. For our listeners getting to know you for the first time, would you give us a little bit more about your story and your current focus?
No, sure. I guess I've been in real estate in one aspect or another pretty much all my life. Started in public accounting, took the CPA exam, worked on a lot of audits of, back then we had co-ops in New York City. Now, they were real condos, operating partnerships. And, so it was interesting, but you only got to see the number side. And so when I left public accounting, I went to work for the Lefrak family, who's one of the largest residential landlords that privately held at that time. They taught me the management side of the business. So I had to deal with union crews, federal and state agencies with tenants who received assistance, as well as go to landlord-tenant court and see what it was like to collect rent. And so then you sort of like get an appreciation for really how difficult it is to be a residential landlord and the games that tenants could play depending on the jurisdiction you're in. Over the years, I've either been a banker or a lender, or worked for owner-operators building platforms and doing asset management. So I'd like to think that, although I'm definitely not the smartest guy in the room, I'd like to think that I'm well-rounded. I've seen a little bit of everything, and I've been extremely lucky with my investment decisions, being conservative and not reaching for the last dollar. But then again, it's also not what you make, it's what you keep, and that's sort of what we focus on, is maximizing the tax efficiencies of our investments for ourselves as well as our investors, and working with tax counsel to figure out the latest in tax avoidance planning to make sure that we have multiple options, even if we have a upcoming taxable event and we want to exchange into something else.
Absolutely amazing. Irwin, I love the background. I love the versatility. I love the way you said you started with the number side, like more like the CPA accounting side of things. And then you went into the management side, the hands-on practical application of moving deals forward. And you've been a banker and a lender for many years all throughout, and also buying your own assets in a conservative way. Love all of that, Irwin. Before we dive into the topic at hand, which is decoding commercial real estate, right? And really making, great, wise decisions. And I want to take one other step back. I believe we've all been given certain gifts in this life, and these gifts have been given to us to be a blessing and help to others. So what would you say is Irwin's superpower or gift, and how does that help how you help and bless people today?
Well, I like to give back. And so I've sat on the advisory committee for Fordham University, helping them plan the curriculum when they got that up on their real estate graduate program, and some of the courses, and mentoring students. And even now I mentor students. I do have a New Jersey educator's license. I could teach in the high schools, and I believe that financial literacy really needs to begin in the elementary school to give young people a little better foundation on how to save money, what's out there in the world. I substituted in a class a year ago with financial literacy for somebody, and they said, we're talking about checking accounts. Here's some curriculum, and I had something prepared. And I was surprised that nobody knew what a bank was. Nobody had a debit card. Nobody knew what a checking account was. Nobody knew what bank products were. And it's one thing I was really surprised about, because my 3 kids know what a bank account is. They all had debit cards. They understand there's a limit. You can't overspend. And even now, my girls, who are 17-year-old twins, are telling me they don't think they're getting enough interest on their savings account. Then is there another product that the bank has to afford them, to earn more money? So I guess, financial literacy is a key thing that I think to begin for people at a young age. And I really think that more of the high schools should actually offer some real estate classes as an elective, even just the 90 or 120 hour elective brokerage and salesperson's courses, but at least teach people understanding principles of investment, return on investment, investment decisions, some basic legal as far as UCC and real estate law. I think would help get people a little more sure-footed when they get out there in the world.
I couldn't agree with you more about Irwin. And we're talking with Irwin Boris, by the way. You can go to heritagecapitalgroup.net, heritagecapitalgroup.net to learn more about Irwin. So Irwin, let's dive right into the topic at hand, which is decoding commercial real estate, navigating investment decisions. So Irwin, what's the number one secret to decoding commercial real estate and making sure you're making great investment decisions?
I think that you have to understand that you can't eat IRR. And that should not be the investment parameter on which you base your decisions upon. I know that a lot of people invested as limited partners and syndications, and when you have a choice of, do you want a 2.4 multiple or a 1.8 multiple or a 25 IRR, people think, well, I'm going to go for the fences, and I'm going to look at that IRR with the highest number on it. And what's happened more as of late is that has not been the way to go. We believe that it's sort of a blend of current cash flow to create wealth, and also pay for luxuries that you might want to treat yourself to, in addition to some appreciation on the sale. And I think that's where some people have gotten into trouble, chasing those grand slams, swinging for the fences. Real estate investing is about putting men on bases and getting them to score runs. It's not always going to be triples and grand slam home runs where you're clearing the bases.
Absolutely. So I couldn't agree with you more. And so it sounds like you can't eat IRR, right? You can't count on it. And really it's looking at the current cash on cash return. I couldn't agree with you more on that. That to me, that's the most important thing when going into the investment, unless there's some astronomical value add opportunity, right? Or just something that's so tangible, so proven that indeed you could buy this 200 unit apartment complex, and 30% of the units have already been, renovated, and they've increased $100 to $200 or $300 more in rents. So it's already been proven pro forma, right? And the cash on cash right now is sustaining and has a positive arbitrage, right? A positive cash on cash. And you have some good debt in place. And then, yes, great. You can probably do a more realistic IRR, right? Moving forward. But again, you're buying it on that first intrinsic value that it can sustain itself. It can get around the bases, right? Versus the home run. Is that a fair summary, Irwin?
That's a fair summary. But unfortunately, most of the value add deals that are out there that have been syndicated, they went in upside down, where your debt was higher than your going in capitalization rate. There was minimal, if any, current cash return to the investors. And as the prices continued to tick up for some of these value add assets, sponsors became a little more creative. They didn't grow the expenses at a high enough rate, or they took short-term floating rate debt and didn't buy a full-term interest rate cap. And now they're exposed because the loans are resetting, and you either have to buy an interest rate cap replacement, which is very expensive in today's market, or like with insurance, it went from $250 per apartment to like $800 an apartment. There was no rainy day fund. The deals got screwed down too tight. But yeah, if you can go into a value add that's proven, and you can have positive leverage, and you have set aside enough capital, I think those succeed. Unfortunately, we looked at one yesterday where the sponsor, I think, had a basis of $180,000 a unit, would sell it for $110,000, and he basically wanted $1 million over the Freddie Mac debt. And I couldn't get it to work. He had a floating rate loan with the rate cap expiring. He needed $1 million for the rate cap, and I just didn't see how it was going to work at all. And I think at that one, I'll revisit it after it's foreclosed by Freddie Mac. and I could buy it below the current debt.
There it is, Irwin. And that's the reality, right? Like, unfortunately, when you have interest rates that go up so high and these cap rates have expired, people have a negative arbitrage, and it just the water starts to sink the ship. And you have deals that operationally and occupancy are actually pretty healthy, but the debt has kind of poisoned the deal, except for insurance costs that have gone up quite a bit. Utilities are also going up. These
payroll and payroll. You want the A team on your property. Payroll costs have gone up in addition to insurance. So it was like almost a perfect storm between interest rates, insurance, and payroll, and of course taxes. All the taxing authorities are still trying to make up for money they spent during the COVID shutdown. It's hard. And then if you look at the history of some of these apartment deals, and I always look at these, and sometimes I'm able to find old offering memos because I'm a pack rat. I save all these things on a cloud. And you look at how many times a deal is sold in the last 12 years and what the business plan has been. How do you replace kitchens and bathrooms every 4 years and justify moving the rents like that? I think you have more turnover and have to always count on new tenants in order to try to achieve some of those returns. But multifamily has always been everybody's investment darling. And I would say that if you're investing in real estate, you should diversify into other asset classes where you don't have the exposure to interest rates and really taxes and really operating expenses, more of a triple net basis.
Yeah. Speaking of diversification, I think it's really important to consider when you're navigating different investment decisions and you're decoding commercial real estate to not just have a cash flow or an IRR, perspective. That's very important, but also have a tax flow, right? And a debt flow. Each of these is kind of like seeing in 3D versus one-dimensional. I think a lot of investors, unfortunately, come in with just a cash flow mindset, and they don't connect the tax flow with the debt flow, or they took the debt flow for granted that interest rates would always be just low, right? And now they're getting hurt, right? And so, talk about the importance of looking at investments and making investment decisions with a 3D approach with all three of these aspects.
No, sure. I think that one thing any investor needs to do is look at the underwriting and stress it themselves. They should say, what if interest rates went up? If it's not a fixed rate loan, they should say, well, what if interest rates moved up 300 basis points? What does the debt service look like? Am I going to have a trouble where I might face a future capital call? Or if I can't make the capital call, am I going to get liquidated down? They should also make sure that whoever the sponsor is ordering a cost segregation report to try to take advantage of any accelerated depreciation that's going to get passed through, and to also make sure that the sponsor isn't keeping all the depreciation, because I've seen a few of those tricks also, where you should be getting depreciation that's a pass through, which will offset hopefully a good portion of your current income from that particular investment. And then to the extent that you're getting excess depreciation, especially if it's an asset that you can really accelerate, that you can use that for offset other passive income that you might have that doesn't have any shelter from depreciation. And if you're going to sell, always, if you're a significant enough investor in a deal, always ask if they'll give you a TIC, a tenant in common interest, because that gives you the more flexibility to exchange if and when the asset is sold and not be tied to the rest of your partnership and have a taxable event. It's all about tax avoidance. So we've been exchanging some of our assets for 25 years and continue to grow the value there. But eventually, I think maybe some generation might have a tax liability, but we're trying to work around that. But in the meantime, we continue to exchange.
Yeah, let's dive right into that, because part of the topic we really focus on, we're really passionate about, is capital gains tax solutions. And you mentioned cost segregation, you mentioned 1031 exchanges, and you mentioned just overall, tax flow strategies there to offset the cash flow. However, there's some limitations to some of these things, and I'm curious what your thoughts are on this. We found that once you fully depreciate, multifamily is 27 and a half years, and you've done exchanges, the old depreciation schedule travels, you run out of that tax flow to offset the cash flow. So there's nothing to cost seg anymore unless you had bought a much bigger property and perhaps taken on a lot of debt, which could be problematic in that. However, the other one that gets mixed up a lot is the estate tax, the death tax, right? We're working with some owners now And as a reminder, as of 2026, the exemptions are perhaps resetting or going back down to set to expire to about that 5 to 6 million single individual, about 10 to 12 million married. And so this is what's called the government's biggest mousetrap, is this debt tax. And so you might build up $100 million with a portfolio of multifamily, but if it's inside of your taxable estate,
correct.
And if you haven't bought enough life insurance, if you haven't gifted enough away, or you haven't given it all away to charity, it becomes this big burden for the estate. So we have a solution. It's called the DST Plus. Okay, not a Delaware statutory trust, but allows you to sell an asset, Irwin, eliminate that estate tax forever. No charity, no gifting, no life insurance required. It does take a sale of an asset while you're still alive. Not only does it do that, your kids inherit estate tax free, but also you can partner with this trust to go buy more assets with a new depreciation schedule, resetting your depreciation schedule. Okay. Now you get about 80% of that the way that it's structured, remain within the guardrails of the structure. But when you hear something like that, Irwin, being that you've been in the business as long as you've been, what comes to mind?
It's all about tax avoidance, and if you can figure out a better mousetrap to avoid any tax liability, especially estate tax, transfer taxes, you should really take a look at it. In some of my more recent syndications with high net worth families, I noticed that all my investors are trusts. So, and they're done purposely to bypass probate and the estate tax. They're qualified, qualified residence trust or personal holding companies or revocable trusts, irrevocable trusts. And I've asked enough questions, and they're all trying to work with different tax people on how to avoid tax on their demise. And I think that's very important that most people don't think about. I know a lot of people that carry, many years ago, bought the old-fashioned second to die life insurance, which on the family level between the spouses to sort of pay for any estate taxes. But now I think it's important to put your home and everything else into a trust, especially not only for estate tax purposes, but also, God forbid, you need to be in any kind of care facility as you get older, that they can't make you liquidate everything. So it's all about structuring to protect your assets for your future generation, if that's what you want to do. Some people are still of the old school that, well, my kids will make their own money. I'm going to take my last breath as I spend my last buck. I still see a couple of those every once in a while.
I could agree with you more, Irwin, and that's why we help people build a capital gains tax exit plan or an estate tax exit plan, because people build wealth, they build their businesses, they invest into real estate, and they build it for 10, 20, 30 years. And if they don't spend some time building that capital gains tax exit plan for just a few hours before they exit, it's too late, right?
Right.
And if they just spend a little bit of time building that, it could have an extra 20, 30, 40, 50% of the proceeds more that go into this trust, of which the children are the heirs, or if they did the 1031 exchange, you can get a stepped up basis for the capital gains tax. Like, these are the strategies that are so important with tax flow, cash flow, and debt flow. But the best part of all of this is timing. So talk about the ability to be able to invest when you want into whatever you want in liquid or diversified investments, and not have to suffer the time consequences of the 1031 exchange. Because let's face it, Irwin, the 1031 exchange sometimes is your enemy, because you're selling high and buying higher 180 days later, right? And you're selling high and you're taking on even more debt later. And that, in the 08 crash, a lot of people who did get hurt in commercial real estate, it's because they overpaid and had too much debt and not enough liquidity. So what's the importance of being able to be out of debt when it doesn't make sense, to be diversified and liquid to keep your powder dry? What would that mean if you could do that all tax deferred?
Well, that means you'd have an infinite amount of time. You wouldn't have a gun to your head. Like on a 1031 exchange, you only have so many days to identify and so many days to close. So you become sort of like a drunken sailor in the market trying to buy, and you're at the the peril of whatever the market conditions are. Where that's on an individual 1031. Where if you can find a seller who's willing to work with you, and you go do a mixing bowl transaction, you could actually have up to, I think it's 6 or 7 years to complete your exchange. And you're not under any pressure. and you don't have to worry about the interest rates. You have time to really find the right assets. And so, and then there's sometimes if you're in a partnership, you have to remember to tick out early enough so you can take advantage of any 1031 exchange.
Absolutely. And so interesting. I never heard of that, the mixing bowl transaction. That one's really interesting. We just released the best 1031 exit plan, Irwin, as a way to give people multiple options during their 1031 to either fall into a Delaware, to fall into a regular 1031, or to fall into a deferred sales trust and get time back on your side and to be able to invest when and how you want to. What we've been doing the last couple of years is helping people exit. Like we did a $13 million exit in San Diego, and it was 4 partners. And like you said, most partnerships, they must all move together to go to the next deal, right? The whole entity must move unless you do some kind of drop and swap. However, the challenge with the drop sometimes is, California, for example, they're calling those exchanges failed, right? And they're calling that. So you got to be careful with that. With the deferred sales trust, since it's not a 1031 exchange, we drop everyone into a trust for their entity or for their proceeds. And that entity, the new trust, owes them back the money via a promissory note. So we're in a separate tax code. And this creates the diversification. You don't have to have the partnerships. They don't have to be all combined. They can be separated. And to us, that's been great. We've been able to invest into lending for a couple of years, making about 10% on some 6, 12, 18-month loans, all while staying tax deferred. And now we're going back in and buying these deals at 20, 30% discount because time is back on our side. Anyways, if people want to learn more about that, then go to experttaxsecrets.com. It's called the best 1031 exit plan to give you that option. Any thoughts on that, Irwin, or anything else about decoding commercial real estate, tax flow, cash flow?
No, that deferred trust is pretty interesting. I'm not that familiar with it, but it is something I'm going to look into because we always get calls from our investors. What do we do? Or I'm in another deal. What do I do? And so as I said, I'm not the smartest guy in the room, but at least have to point them in the right direction to try to get a little more information. The tax code is ever evolving, and whether it's state or federal, they're always trying to close loopholes. So you make sure you have to have the right current tax advice because no one wants a failed exchange on their hands.
100%. I couldn't agree with you more. If people want to learn more about that, you go to capitalgainstaxsolutions.com. You can also check out the new book, Building a Capital Gains Tax Exit Plan. It's on Amazon, hit #1 bestseller, and it's all about the deferred sales trust, also how it compares to the Delaware Statutory Trust and the 1031 exchange. And it gives you an idea of how to accomplish these strategies. And we call it the proven playbook for unlocking your ideal wealth plan when selling assets of any kind. And the best part too is you can go back into any other assets of any kind, all tax deferred. It's really that great. No timing restrictions. Go to capitalgainstaxsolutions.com. That being said, Irwin, are you ready for the lightning round?
Sure, why not?
All right. Knowing what you know now, Irwin, if you could go bayou to your 25-year-old self, what's the one golden nugget you make sure to tell yourself to do?
I think I would have invested more at a younger age. And, you figure you always have time on your side, but I think time helps you make money. I did buy, some IUL policies in my 20s, and everybody thought I was crazy, but the life insurance was cheap and the cash value is now tremendous. I think I would have done more of that. I think that younger people really need to put more money in IRA accounts in their 20s or into fixed indexed annuities, because then basically you don't have a taxable distribution, you borrow the money out. So you need to start your tax planning for retirement and not have to worry about minimum required distributions. And so most people don't think of that until they get closer to retirement age. It says, I got all this money in a retirement account. I'm going to have to take it out, and it's going to be a taxable event. So I think you need to find some alternative vehicles so you're not have to hit with that requirement.
Good. Great wisdom. Question number 2. What's the #1 book you've recommended or gifted the most in the past year?
I've read Influence by Robert Cialdini. Talks about the psychology behind sales. And also, I've read Grogan's book, is The Navy SEAL. And the other one I thought was the book by the FBI negotiator, whose name escapes me.
Chris Voss.
Yeah, Never Split Voss, Never Split the Difference. And how you're supposed to start your sentence with how they finish their thoughts, and how that calms people down and gets them relaxed. And yeah, I would definitely hire Voss to be my negotiator if I had a serious corporate takeover negotiation.
100%. I love Chris Voss. That Never Split the Difference book is incredible. Highly recommend that. In fact, even more than that, I recommend the masterclass where Chris Voss breaks down live training on that entire book, and mirroring and labeling and being able to tactically empathize with everyone that you communicate with, not just negotiating deals, but all communication. So never split the difference, but get the masterclass on Chris Voss as he goes through that. Next question, Irwin, what are you most curious about right now?
Where are interest rates going? No one can predict it. You had some of these experts, I think it was Goldman Sachs, who said there's going to be 6 interest rate cuts in 2024. I don't see it. And I guess when Powell was on TV and they gave their conference, he's like, well, we're done raising, but the data is not there to warrant the cuts. So I think maybe you see 2 in 2024, if we're lucky. And, so it's an interesting time in the market. And I wish I knew where interest rates were going, but in the meantime, I'm taking advantage of the lack of buyers.
There it is. Yeah, absolutely. Second to last question. What's the number one leadership quote or theme that you strive to live by?
I guess you really got to, live one day at a time, and you got to be eyes wide open. Don't project too far down the road. Man makes plans and God laughs. And I think you got to accept things at face value. Not everybody has an alternative motive, although some do. And I think it's about how you deal with people. And I've learned over the years that your inner circle continues to get smaller.
So much wisdom there. I think there's about 2 or 3 books in that last sentence. I love that. Last question, Irwin. After all your success, helping all the people decode investment real estate, commercial real estate, help them create and preserve more wealth, how do you best stay centered in your values and stay encouraged to charge forward to reach even higher heights?
My partner, our principal, was interviewed recently, and he says, how do you describe what you do? He said, boring, which I thought was really funny. We're looking for, just to put, as I said, put men on base. We're very conservative in our underwriting. We take full-term interest rate caps. We like to sleep at night. We don't borrow more than 60%. I think that it's about the balance of quality of life and trying to make money and trying to provide for your family and helping others. You have to find the right balance that works for you.
Irwin, it's been an absolute pleasure, and I know we're all better for it. I want to thank you for sharing your wisdom with us, sharing your insights and the details on cash flow, tax flow, debt flow, and decoding some commercial real estate for us. We're definitely better at navigating investment decisions, spending time with you. I want to encourage you to keep using your gifts of giving back, mentoring others, and helping them with financial literacy in every way possible. And that being said, for our listeners who want to get in touch with you, would you remind them one last time, what's the best place for them to find you?
No, that's easy. You can put my name in the search bar, Google Irwin Boris. You can go to Irwin at heritagecapitalgroup.net. You can go to heritagecapitalgroup.net, the website. We're revamping our website, so it might forward you to the new website, but everything's up there. Talks about what we do, some investment advice, how we underwrite, how we do due diligence. And if you have an interest in investing, you can get on the wait list. It's fine.
Amazing. Thank you, Irwin. I also want to thank our listeners for listening to the episode of the Capital Gains Tax Solutions podcast. We're also streaming on Expert CRE Secrets podcast and YouTube channels. Appreciate everyone watching on either of those channels. I want to encourage you that every single day you have an opportunity to do some planning and to do some strategic relationships, right, to help you create and preserve more wealth. And not having a plan is the enemy, but using proven tax referral strategies to create and preserve more wealth, such as the deferred sales trust, the 1031 exchange, the Delaware statutory trust, are amazing ways for you to create and preserve more wealth. And working with people like Irwin Boris, who have extensive experience and a proven track record to invest with passively, is also a great way to create and preserve more wealth. Hey, we touched on a number of things today, but I want to remind you of a couple things that we offer you right now. And that the first one is the ability to defer capital gains taxes, not having to be in a forced 1031 exchange. You heard about it earlier. I want to encourage you to go to capitalgainstaxsolutions.com to get started on your deferred sales trust plan. It's 100% conditional, meaning it's no cost, no obligation. We will work with you to structure everything, get you everything aligned. If you want to use the 1031, great. We have that as well. And the best 1031 exchange exit plan, we have the option to do both, okay? And so you can go to experttaxsecrets.com for that one. But either way, we look forward to connecting with you real soon. And we appreciate everyone watching out there on YouTube or listening to us on the podcast. We'll talk to you